Welcome to our event, the Rolling Fund series. I'm Jill. I'm the venture principal at Capital Factory. I manage our seventh venture fund, the Texas Fund, which we'll be chatting about more today. For those of you that are not familiar with Capital Factory, we're the center of gravity for entrepreneurs in Texas. We host a ton of events and programming like this one today, and you can find more of our events on capitalfactory.com/events. We also have co-working out of our Austin, Dallas, and Houston offices. We have a startup advisory program called Capital Factory Ventures that over 550 plus Texas startups have participated in to date. And we also have a venture capital fund where we invest in the best early stage startups in Texas, generally speaking, seed to Series B. According to PitchBook, we are also the most active early stage investor in Texas since 2010. Today, I will be joined by Josh Baer and Sunil Pai, and they'll be hosting a conversation on rolling funds and Capital Factory's seventh venture fund, the Texas Fund, which we actually structured as a rolling fund this time. We're really excited to chat more about this with you all. So throughout the conversation, please put questions in the chat. It's to the right of your screen, and our fund team will answer any of your questions. And at the end of the conversation, we'll also come up and answer a few questions live as well. After their conversation, if you're interested to learn more about the fund or invest alongside us, you can access our AngelList page by going to capitalfactory.fund. And if you'd like to set up a private meeting to chat more, you can email me, jill@capitalfactory.com. All right, it's time to introduce our speakers. So today we're joined by Josh Baer, who's the founder and CEO of Capital Factory, and he will be introducing Sunil Pai, who is a venture partner at AngelList and did a lot of work on the creation of the rolling funds. Welcome to the stage, Josh and Sunil.
Awesome. Well, welcome, Sunil. It's great to see you and finally meet you. I don't know if you call this in person or not, but at least face to face.
Close as we can get.
as close as we can get. I'm Josh Baer from Capital Factory. I'm here with Sunil Pai from AngelList and the new AngelList Rolling Funds, and we're going to have a little conversation today to learn a little bit more about how the rolling funds work and the new one that we are launching here at Capital Factory. So thanks for joining us today, Sunil.
Of course, thanks for having me. Excited to do this.
So Sunil, I feel like I go way back with AngelList, like way back to the beginning. I met Naval really right around the time it was launching. To me, that was around 2009 was when it really started to get into prominence. And I see how it's gone through many different evolutions over time. And I'm so excited about this latest kind of new product, this newest evolution that continue to democratize investing and kind of make it open up the ability for anyone to be an investor and anyone to run a fund, and then for more and more people to participate and invest. So that's what we're going to learn a little bit more about today. How did you get connected to AngelList? What were you doing that brought you into this?
Yeah, so originally from the Midwest, grew up in Oklahoma, and then came out to Berkeley for school, did a couple of years of management consulting out here, and then saw kind of the startup boom happen with my friend group when I graduated. A lot of my friends were going to Y Combinator, starting companies, or joining hot companies at the time, which was like Zynga when I graduated. And then I wanted to see kind of the other side. I was wearing a suit and tie to work. A lot of my friends were at startups, early stage companies, very different kind of pace of what they were doing. So in kind of learning more about startups, potentially joining one, I actually got introduced to the venture firm DFJ, Draper Fisher Jurvetson out here, and I got recruited to go join the investment team. So did that in 2013 and was there for about 4 years on the early stage side, $350 million fund, early investors in some great companies like SpaceX and Tesla, Box, Twilio. So got to see a whole bunch. Got to do some great deals, kind of see the whole process from sourcing to diligence to managing and being on the board. One of our investments was actually an AngelList. And so I got to know Naval, kind of what was happening under the hood there. And when I realized that model of venture was very different and kind of innovative on just getting capital to startups, I got really excited about it and ended up joining the team in 2017. So I've been here for about 3.5 years. And my role is managing the GP side of the marketplace. So I'm a partner on the venture side, and I work with our GPs, whether they're interested in syndicates, what are SPVs, or traditional funds, or help manage our rolling funds offering as well.
Great. And a GP is somebody that runs a fund.
Yep, exactly.
I wear lots of hats. I'm a founder, I'm an entrepreneur, I'm a mentor, I'm an investor, I'm an angel investor, I'm a GP, I run a fund. I'm fully buzzword compliant. But when you say a GP, that's a general partner. That's kind of the main person making the decisions for investing the money in the fund.
Exactly right. So the terms are not mutually exclusive at all. There's a lot of crossover. A GP can also be an LP. But by GP, it's general partner, folks that are actually sourcing, negotiating, making investment decisions with deal flow coming in.
Great. So, talking about LPs, one of the things that's so interesting about LPs is the AngelList kind of changed the definition of LPs and who traditionally LPs were. Traditionally, LPs were like big institutional kind of endowments and universities and things like that, right? Like how has AngelList changed that?
Yeah, so I'd say there's a lot of different categories of LPs. LPs are the folks that provide the lifeblood of startup growth, which is they're the ones that are providing capital. And capital in different pockets. It can come from any accredited individual or family offices and qualified purchasers, or institutions like you mentioned, like endowments and grants and large institutional LPs. What AngelList has done, basically, we're a startup ourselves. And so we are a fast growing technology company. We've brought a lot of the tools and infrastructure online to be able to manage a fund. And when you do that, you decrease the cost. So we're totally vertically integrated for all the SPVs and funds we manage. We handle everything, and we bring down the cost to a fraction of what they would be. So that enables more GPs, folks like yourselves that have great deal flow, to get into business. And it changes the category of LPs because now you can start accepting capital from those different segments. If someone wants exposure into the private market and they're an accredited individual that wants to invest, $10,000 into a deal, they're able to do that. And so what we're doing is, as you mentioned earlier, really democratizing that workflow so that more people can get access to game-changing startups.
Yeah, it's I find it so fascinating. When the first product of the funds that AngelList had to offer, as I understood it, was the SPVs that you mentioned, or the syndicates. Mm-hmm. And that really, if I had to describe it to somebody kind of simply, I would say it was like DocuSign or HelloSign mm-hmm. for putting together a one-off deal. Like, I've got this allocation in a certain deal, and I want to let all my friends invest in this one allocation. So we're going to put together an SPV, a special purpose vehicle, or a syndicate. And AngelList just made it so easy. I could fill out a bunch of fields on a web page with all the details we needed, and it would put that together in a legally compliant way to create a new fund structure, and not only put the deal together and let me send it out in the right way to all my investors and let them sign up and say they want to take it and close the transaction, but possibly more importantly, to actually keep managing that for the life of the investment, right? So follow up with all the filings and technical details and kind of keep track of everything, which if you're doing a whole bunch of these deals can be a big pain in the butt. So that was version 1, was the syndicates, right? And is that a pretty good description of kind of
exactly
for doing a sidecar?
Extracting away the complexity. Ultimately, the startup needs money. You're the value add as the GP. You're working with the startup, and then there's capital behind the scenes. We've basically abstracted all of the boring back office paperwork to make this digital and enable these transactions to happen more seamlessly.
Yeah, like why reinvent the wheel? Everybody who has the fund looks about the same. Just do the same deal, choose how much carry, what are the fees, go, or whatever the questions might be, and go. And not only makes it easy, but it makes it much cheaper, right? So it allows more deals to happen because the expenses are so low. The typical fees on a syndicate are like $8,000, right?
Yeah.
And I love the transparency, although I wanted to give you some feedback because it says, fees, and it calculates, and it says, hey, you're doing to keep the math simple, an $800,000 syndicate. So the $8,000 is 1% fees. Mm-hmm. But I think that's actually, in some ways, a little confusing, might be, to some investors, because they're used to seeing fees 2 and 20, which is 2% annual management fees and 20% carry. But it's really 20% fees because you pay 2% per year for 10 years. It's like 20 and 20. Then it sounds better to say 2 and 20. And if you were to compare that to when I see the 1% in my syndicate, it's really 1% compared to 20%, not 1% compared to 2% that a lot of people might think of. You know what I mean?
That's good feedback. Yeah, what we mean by that 1% is it's not a management fee; it's a one-time setup fee. So on the 800K example, it's just 8K off the top. You know, the rest is going entirely to the company.
But most SPVs, that's the only fees, right? You know, like they're most syndicates, that's the fee, and it's not even, you know, it's not even half. It's a tiny percentage. It's almost negligible. So by doing that, it makes it easier to do a syndicate for a smaller amount of money because you don't have a bunch of fees, right? You don't have to track it. So I know for me, that's made it much easier to do sidecars, to do SPVs. So then, what was the next product?
Yeah, so what we noticed, and keep in mind, all this progress and the growth has been happening in the past 4 years. So when I joined AngelList in 2017, we had one venture product. It was SPVs or syndicates, what you've described. What we noticed and kind of the narrative that was happening was when you decrease the friction, you allow more people to enter the market. And people started getting really excited about this. So with a syndicate, you're just investing in a company one time. And so you can do one deal a year, or you can do 50 deals a year if you have that much deal flow. And so what we started noticing is people started doing a lot of deals. At that point, I mean, we'd managed over 2,000 transactions. And some people were actually doing 50 deals a year. And, you know, maybe they would graduate off of the platform and go raise a fund. Because instead of raising capital on a deal by deal basis, they just wanted that pool of capital to go and invest. So after that, we launched traditional funds. And that was basically bringing that offline process online. So when you start a venture fund, and you all are very familiar with this, you need to set up your legal documents, set up a relationship with a bank, find a fund administrator, tax, valuations, distributions, portfolio management, all of that stuff. We said, hey, we've built this infrastructure online, for syndicates. We can now apply a traditional fund structure. So we launched that so that GPs could raise capital from LPs in a dedicated vehicle. And then anytime they found a great founder they wanted to invest, they could say, I'm in for 800,000, and the money gets wired the next day. So it's just having that capital up front for many deals instead of raising on a deal by deal basis.
So in many ways, you did the same thing. You made DocuSign for doing a whole fund instead of just a one-off deal, right? I can just fill out a bunch of forms on a website, and I'm a VC. I've got a fund, right? And so, okay, so you keep doing this. You're charging $8,000 to run a syndicate for possibly 10 years, hopefully less. But like, you can't be making much money on that. Like, what's the business model? Why would AngelList do all this if you're driving the cost down so much, and you're basically providing all the administration and back office, what seems to be almost at cost?
Yeah, it is very close to cost. So what we're doing, there's a lot of efficiencies of scale that we get by doing so many transactions. There's a lot of technology that we've built under the hood. And the way we're able to do this at such a cheap price is we are a technology company. Unlike other folks that are more services oriented, they throw bodies at the problem. We've kind of built this software out, this infrastructure out that makes it very easy to run another deal. But the other component of our business model is, since we're running these transactions, we've got folks like you that are sourcing deals. We've got LPs who have capital. We've built a marketplace. And so on top of this, people can come to AngelList with a deal in hand with their LPs. But if it's a deal that other LPs on the platform might be interested in, we can potentially drive more capital into those companies. And so part of our business model is, if AngelList drives platform capital into these deals or into these funds, then we share in the carried interest on the capital that we drive. So we are almost becoming like a co-GP on that deal, where you would earn 15% carry out of the 20%, and we would earn 5% if we're able to drive that capital. So we share in the success. I think we lost your audio, Josh.
Sorry.
Oh, there we
go. So we run a deal. I set it up. I bring my investors to it. Normal thing. I collect all the money like I normally would. But if I can't fill it up myself and you bring some other investors to it, you take a piece of the carry.
Exactly.
So it's almost like you're a software company that invests like a VC.
That's right. Yeah. So we've got those two kind of planks to our business model, where we build this tool that investors use, And on top of that, there's benefits and there's network effects of having all this capital and having that machinery in place, and it benefits everybody because it creates more dollars into great companies.
Wow, that's brilliant. Okay, so then how does that get us to the rolling fund? Why is that needed once you had this? You already have kind of like the easiest way to create a fund and set it up and manage it. Why do you need a rolling fund?
Yeah, so with syndicates, what are SPVs, special purpose vehicles, we did something which was important and innovative at the time, which is brought that offline process digital. With traditional funds, we did the same thing. Instead of having those 8 different service providers, we integrated it, brought it online, but it's the same model. And with rolling funds, I'm really excited about this offering because it's truly something different. AngelList is the only platform that offers a rolling fund. And it's a new structure to venture capital. What we thought about was, with a traditional fund, GPs often, they go out and they fundraise. It's traditional to do it for 18 months. And you go do a roadshow, you meet a bunch of LPs, you set a target raise, you think about your strategy. And at the end of 18 months, it's pencils down. However much capital you raise, that's it. Maybe you hit your target, maybe you're oversubscribed, but at the end of 18 months, that's where you're at. And because of that, often GPs are talking to LPs to raise their fund. They might miss out on great founders because they have that, time box window of when they can raise. And the third problem is that what happens in month 19 if an LP comes up to you and says, I'd love to invest. I didn't know you before, but I'd love to put in $500,000. You have to say, you got to wait until the next fund. There's no opportunity to work together because the fund is closed. And those kind of seem like artificial constraints. If you were to actually think first principles, how should a venture firm be built? You wouldn't construct it this way. This is just how it's been done for the past 40 years. And so given that thinking, we were saying, with this infrastructure, what can we offer to solve those problems? And that was the genesis of the rolling fund. So the analogy that we like to think about is moving venture from like an old, stodgy enterprise legacy model to a SaaS business. So rolling funds are essentially an open-ended venture fund. So you can constantly be taking new LPs in at any given point. You don't have that artificial 18-month window. You can start raising, you can stop and pause raising whenever you want, and you can be more flexible about the LP base that you invite into these deals. And importantly, we've structured them, and I won't bore you with all the details, but it's designed as a 506c fund, which means you're able to generally solicit. You're able to go on a podcast. We can record and talk about your fund like this, and you can release it publicly. Everyone still needs to be an accredited investor, but you have more surface area of what you can talk about. And so that aligns very well with our theme of democratizing investing, bringing more people into the fold of great startups.
Right, and kind of like DocuSign and making it easier to close the transaction, you also kind of make it easier to do a public kind of offering like that, to be able to offer it this way.
Mm-hmm. That's right. So because you're able to talk about it to the general public, because you're able to talk about your track record, you can bring more people into the fold. And we think that's really important, where, access to great companies shouldn't be behind closed doors. It shouldn't be a whisper network of who you know to get you into the deal. It really is for people that want exposure to fast growing technology businesses. And if you look at the public markets, look at Airbnb and DoorDash and the top businesses in the market, they're technologies. They're not utility businesses like they were before. And we think it's great to involve people and share that upside earlier in the process.
So I'm familiar with this concept of an evergreen fund. Mm-hmm. What's the difference between an evergreen fund, which sounds a lot like it, and a rolling fund?
Yeah, evergreen funds are have been popular a little bit more on the hedge fund world, where typically sometimes it's a sole LP that comes in, they renew the capital. When a startup exits, they just recycle the profits back into the fund, and it just keeps going and going. So it is a similar concept, but I would say a rolling fund is different, and we call it just an open-ended venture fund, where LPs can come in and out at different times. They have different subscriptions. So an LP can come in and say, I'm in for 100K every quarter for 4 quarters. And then at the end of those 4 quarters, say, I'm out, I need to buy a house, I need to do this. Or they can say, this is great. sign me up for 8 more quarters and I'll put in 250K every quarter. So it allows you to bring people in and out of the fold of your fund at individual moments, unlike what a traditional fund used to do, which is an LP would say, here's $1 million. And then, they wait for 10 years and they see what you made of that. This allows a little bit more dynamism and flexibility.
So let's touch on the mechanics a little bit more too, because you hinted at this, but when we say it's like an open-ended fund, it's really not one fund. It's really a whole bunch of funds, right? It's a new fund every quarter, which for most people, most other investors or fund managers, that would sound insane, right? Like, how could you possibly do that? Well, you could only do that if you already built all the infrastructure and the DocuSign and everything else to make it really easy to launch new funds, right?
Yeah. You know our business cold. That is exactly right. So the magic trick that allows this to happen is that we do set up a new fund every single quarter. And so that allows LPs to come in and out of that fund cap table because there's something new that's created. And there's a tremendous amount of complexity, as you can probably imagine, with accounting, with managing the carried interest, with tax, and, all of those things to get it right. And that's where software comes in. You can't do this with spreadsheets. This requires like true deep infrastructure and software that we've been building over the past 10 years.
Well, I'll tell you that it really resonated with me when I heard about it. I mean, first of all, I was like, did you make this for me? Like, this is exactly what we're kind of doing this anyway. We're forced to do it and call it a different thing. But we're a small fund. We were always fundraising all the time. Like, I know most people do what you said. They spend 18 months fundraising and then they stop and they spend, 2 or 3 years investing it. Well, we more like bootstrapped our funds. We would start raising the fund. I would put in the first money myself. And then we would start deploying it while the fund was open, while we're still raising more money. So, and because we were just, we had a lot of deal flow and a lot of opportunity and we didn't have access to as many LPs, most of the time we were fundraising the whole time the fund was open.
Yeah.
And right about, literally almost right up until the end, maybe we would get 6 months or a year where we were closed and we were, just investing and getting ready to raise the next fund. And then what do you know, as soon as that ended, it was time to go raise the next fund again. And we were kind of caught in the same position. And so in many ways, this is just calling it what it really was. This is what we were doing anyway, but it gives it the right name and the right structure and sets it up with this auto renewing subscription so that, people are kind of signed up to keep going. It just sounds like it was made for us. And then to throw on top of that, we have a great brand, we have a great presence, and we have the ability to get it out there, but we couldn't quite talk about it the same way. And now, again, we probably could have figured out technically how to go check all the boxes and be able to register properly to market it, but we wouldn't have because it was a big pain in the butt. But we get that for free, and now we can talk about it publicly too.
Yeah, I think it's a great model, and I'm glad it scratches the itch here because some people might say, okay, well, with an open-ended venture fund, aren't you stuck always raising? Isn't it good to pause and have a fund 1 and a fund 2? And we see that, but our perspective is a rolling fund actually offers more flexibility than a traditional fund. If you are happy with your fund size and you've got these subscriptions coming in for the next 4 quarters or 8 quarters, you can say, I'm not going to take any more coffee meetings with LPs. I'm fine right now. And then you can kick off into gear when you want because you've got this SaaS recurring model of capital coming in. And then you never have to turn away an LP. If there is a great LP and they can be value add to you and they're ready to write a check, you can take them in at any time. So there's no constraints here. It's up to you to figure out the strategy of how you want to maneuver, but it's entirely up to you.
Yeah. I'll tell you, there's one other thing about our model of investing, our investment strategy, that when I heard about the rolling funds and the ability to market them publicly, and the quarterly nature just made me think it was an even better fit. Like maybe it was actually just made for us, even more so than anybody else.
Yeah.
And that's because, one of the really unique things about our investment strategy is we have this pretty unique accelerator model that allows us to acquire investment rights really at scale in hundreds and hundreds of companies over the past few years, over 100 companies a year. that we engage with, and we get investment rights. We get the right to invest in. And then we get to wait and see if they raise a round, if a VC comes and leads a Series A, and our strategy is to invest alongside those, not to lead the rounds, but to be a secondary investor alongside them. And we've been collecting these rights for a really long time. And so, obviously you can imagine the time between when we meet them and when those rights get triggered, it's often a year and a half, 2 years, sometimes even longer. And we've been doing this now for many years. So we got a pipeline. I know who our investments are going to be next quarter.
Yeah.
Because we've been cultivating them for the past 5 years, right? And I've got a list, and we know which ones are at the point where they're going to be raising money or getting low on money or have a certain traction level and are planning that out. And so we've got, not only can we talk about it, but we've got a really good picture of what those companies are that we can say, here's what our pipeline next quarter looks like. And I think, not a lot of firms could be able to do that or be able to talk about it because we have the rights. Like we know we're going to be able to invest in them.
Yeah, I mean, investing is all about having information asymmetry, having an edge, and just that predictability of being able to see, where the puck is going, what's coming down the pipeline, having that visibility, and then raising capital around that is a great strategy. A lot of people are far more reactive, where, with an SPV or something like that, the opportunity arises, then you raise capital, you react to it. Here, if you've got, the companies that you can see in pipeline when they're going to raise, you can go and talk to your LPs about that, create a new strategy around that model.
Yeah. And I'll tell you, we plan on using multiple of the AngelList funds and tools, right? We're using the rolling fund as our primary strategy to capture all of our immediate investment rights and those early stage investments where we focus at the kind of seed and Series A and maybe early Series B stages. But as we've been doing this now for a long time, what happens in the Series C when our pro rata is $1 million or more? Well, that doesn't quite fit the investment strategy for our rolling fund, but that's a great opportunity for us to do a syndicate or an SPV, right? And do that around those pro rata rights. And I see that happening probably on a monthly basis next year.
Sure. And it also, it jives really well with what we were talking about earlier, which is there's different LP profiles. There's, some LPs, accredited family offices or institutions, some that want early stage exposure, some that want later stage exposure, some that want to write small checks, some that want to write big checks, so that, there's not necessarily perfect overlap. So you could say my rolling fund is going to do seed Series A deals. And then when the companies mature, when we have those large pro rata rights, then we're going to open up this SPV and we're going to invite this different, class of LPs that are ready to write big slug checks into late stage deals because that makes sense for their portfolio construction. So you can kind of have the best of both worlds.
All right. So I'm imagining it's me and you, it's 3 or 4 years from now, we're having another conversation like this and we're looking back in time and I'm saying, wow, I'm saying, Sunil, I came for the DocuSign. I came for the ease, of friction, but I stayed for the LPs. You brought me all these LPs, and wow, that's that's what I want to be saying, because I'll tell you, we are capital constrained. We have all this deal flow we've been cultivating, but we're in Texas. We don't have access to all the same capital markets and all the same investors, and that's part of what I'm super excited about the platform bringing. How do we make sure that our fund and our opportunities are getting seen by the best AngelList LPs?
Yeah, it's great. So I think part of this is having the flexibility around marketing. Having these type conversations increases the surface area of fundraising. We have a bunch of folks that are interested in investing into different rolling funds. We have a bunch of LPs that are interested in investing behind emerging managers. And right now we are in the early access program of the rolling funds. So we've got hundreds of applications of GPs who are ready to start funds, but we've kind of prioritized differentiation. And that's what I think is really special about what you all are doing. It's not another, early stage Silicon Valley fund based out here, with LPs here. It's a different strategy. And I think that could be potentially really exciting for our LP base, just seeing something different. And so there's a lot we could do in terms of putting this on our website, sending it out to our LP base that might be interested, and working together to grow this.
All right, talk to me about Texas. You're out in the valley, Silicon Valley. Of course, I'm not a basher or anything. Like, I think Silicon Valley's Hollywood. It'll always be, it'll be an incredible place. But hard, of course, I'm drinking the Texas Kool-Aid, but hard not to notice the tidal wave of people, companies, investors packing up and moving and coming here to Texas. Jim Breyer from Excel and Joe Lonsdale from 8VC and entrepreneurs like Elon Musk and Drew Houston from Dropbox, and Tim Ferriss was early on the train getting out here. I mean, it seems like there's so many great investors and other people coming here. What are you seeing, and what do you think about why Texas? Why are they coming here? What's attractive about it?
Yeah, I think, this was a long time coming, and I think COVID actually just pulled the future forward in a really succinct and tight way. But this change was happening. When businesses are cheaper to create, you can spin up, AWS and create a business from anywhere. It was inevitable that you don't need that cluster of geographic proximity to create startups. And when startup exists anywhere, there's no reason that the capital has to be from a particular place too. So if you look at the origins of Silicon Valley and what made it special, back in the days of like designing chips, and then the education institutions out here, it was like a very good virtuous cycle that made this a hub of technology. But it was inevitable that Silicon Valley is not going to exist like this forever. There will be new hubs. And I think COVID really brought that into question. When people can work from anywhere and they can prove that you can still be productive, then why do I have to be in a particular area? And so a bunch of folks have moved, and I think that's great. I think Texas is amazing. I mean, the state taxes, there's the food, the weather, there's a lot to love. And so I think that, it's actually a great thing that now the entrepreneurs who have clout, like the Elon Musk, are going other places and creating new ecosystems. And for us at AngelList, falls very aligned with the democratization. An LP, a GP, a startup can be from anywhere. And, if they're talented, if they're doing good work, they should be funded, they should be propelled to go build what they're doing. And so we're very excited about that trend, and excited about what you all are doing in bringing, more capital into the Texas ecosystem and the startup network there. There are a number of great winners, a number of great companies that already exist, and there's going to be a lot more now that more talent is flowing into these areas. I think you might be on mute.
I think of AngelList and certainly Naval and Nivi as Silicon Valley as it gets, at least from my perspective out here, and super plugged in and obviously in the middle of all of it. And at the same time, and I'm sure you know this, but the impact, the reach of AngelList and the ability to help companies outside of Silicon Valley is so dramatic because it is democratizing, because it does open it up, because it does allow them to be in Silicon Valley in some way, right? Mm-hmm. And for investors, to get access to those deals as well. And so we're super excited to be part of that too. Mm-hmm. We're excited to be launching this rolling fund, which we can talk about publicly, which you can come and find by finding us on AngelList. It's angel.co/Capital Factory to find Capital Factory. Any other tips for investors that want to learn more about rolling funds and on AngelList?
Yeah, we've got a site with a lot of information if they're interested in learning more. So it's just angellist.com/rolling, where they can see some of the live funds right now, see different strategies. We've got some early stage funds, some late stage funds, some focus on particular sectors like climate change, others that are more generalist. Excited to bring you all into the fold when the fund is live, so that we can work together on it, and really excited about the capital that it's going to provide in the ecosystem.
Awesome. Well, I'm really excited to be launching this too, and excited to be working more closely with you all in the future. Hopefully, we'll actually see you in person out there or down here in Texas when it's all safe.
Trip out there, would love to.
Yeah. Awesome. Well, thanks so much, Sunil. We'll be seeing you on AngelList.
All right. Thank you.
All right. Thank you, Josh and Sunil. I learned a lot from that chat, and I hope you all did too. Again, if anyone is interested to learn more about the fund or invest alongside us, you can access our AngelList page by going to capitalfactory.fund. And if you'd like to chat one-on-one and do a private meeting with our fund team, you can email me at jill@capitalfactory.com. Thank you all for joining us today. you.